So let's look at Ethereum USD today. At the moment we are bearish, so I'm looking at price which is balance price range here, which is definitely time based. We've been looking good on our higher time frame. We look at our chart for quite a while now. We've been in a downtrend from this high to this low, most likely targeting liquidity within this level front line. But since it's a weekend, we are looking to make short-term trades and exit immediately. And the euro, sorry, we had an SMT with Bitcoin, which is a correlating pair with Ethereum, and which Ethereum was having a lower high and Bitcoin having a higher high. Talking about SMTs, what do I consider a smart money trap? When you have two correlating pairs, let's say Bitcoin making a higher high, retracing, and then sweeping a previous high, and then continuing lower, creating some sort of breaker block formation. Something like that, something breaker block. Then we have Ethereum at this point, all trading at the same pace, creates a high like so, another low, but then fails to run that high, and then retraces to the downside and make our entry high. So in this case, we have what you call a smart money trap right here. If you see this, when you see this, let's name this BTC. XAUUSD. Here we have BTC. So there. So this is what happened yesterday. We had this kind of move. We had an SMT where we had Ethereum moving, trading lower than the Bitcoin. So in such a case, we expect Ethereum to be the one we trade. Why? If we are selling, if we are in a selling market like we are in right now, we would want to sell Ethereum and not Bitcoin at this point, because we are having Ethereum moving lower, faster, and better than Bitcoin. So that's why I'm focused more on Ethereum than Bitcoin over this weekend, because Bitcoin is a little choppy due to this SMT, smart money trap, where smart money manipulates traders at this point, which smart money concept traders consider it as inducement. Falls high, then sweep it later, and then come down. Those traders use the turtle soup. This could be your turtle soup. Creates a high, runs it, then continues lower. This is not a unicorn model. Unicorn model keeps going higher, and then there's a small retracement. We will go through that in another video. But this is what happened and what I wanted to explain to you. So yeah, it is a smart money trap occurred, giving me a clear direction, and it also shows you that the market is most likely to make a reversal. The market is most likely to make a reversal when you see an SMT to correlating pairs like Euro USD and GBP USD. When you see such, it's the same thing. BTC USD and Ethereum USD, same thing. You're going to have a potential reversal. So yeah, that's what I saw. Now back to the Ethereum trade that we are expecting. So we see we are bearish. We have shifted structure to the downside from the not from here, from the 1 hour chart. Excuse me. Yeah, from the 1 hour chart, this swing low confirmed the market structure shift, leaving us with this inefficiency, which price displaced from. So we go back, going down to the 30-minute chart. We have this liquidity resting, sorry, liquidity resting below this shaded area right here, this blue box. This is what I call our daily reference point, where liquidity will be resting. So price will run the high, which it did at this from here. If you go to the 5-minute chart, you'll see that price comfortably went above this, shifted structure, and started retracing to the downside. Now, my target is this liquidity resting below this swing low right here. That is my target. So, that is our draw on liquidity at the moment. Though the market is looking a little bullish on lower time frames, but on a higher time frame, we have a draw on liquidity down here because of this timing. You can consider this our Asian session because I believe price Asian sessions, sorry, trading sessions exist, yes, but do they affect the market? No, they only provide periods of volatility in the market. That's when you know you have to trade. Otherwise, the algorithm has its own settings. It moves according to time. When it's the right time for the algorithm to do something, it's going to do it. When it's the wrong time, it won't do it. So we have price rallying all the way up to this, breaking structure to the upside from here, all time based shifts of market structure. When price reaches this point, of course, I use macros and not only macros of the hourly chart, but we have macros on the 4 hour, on the daily, on the weekly, on the minute. All that will be put somewhere, and I'll release a full guide on how to trade like this. So down to the 3-minute chart, we still have the same bearish momentum from around 8 East African time, that is UTC plus 3, to the current moment. So we look for sales only. Of course, if you can see an opportunity to counter trade in the 1-minute chart, I wouldn't say no to that, only if you have good entry and exit instincts. I can't tell you that it's going to be right for you to do that. So what you do now, we go to the next window. Our first window, we are focusing on times between the 55th minute to the 5th minute of every hour. Actually, no, of every 30 minutes. So every 30 minutes, there is a window for entry. That means that's our macro coming up. Now, you go down to the 1-minute chart and you look for PD arrays defining the direction you want to trade into. For example, the previous window was at 9:55 to 10:55, where we saw price rally to the downside, retrace, sweeping liquidity above this high. Now, when liquidity is swept within that window, expect a breakaway gap to be formed. That is one condition that can help you to refine and find out breakaway gaps. So when liquidity is swept aggressively and price rallies low, you make your entry at the first candle that closes below any inefficiency. For this case, we have a balanced price range. So price comes, this candle signifies that we are bearish. So you can make your entry from here, stop loss just below that inefficiency, because this is an implied fair value gap. Just below that, targeting a simple 1 to 3, and that is your scalp. Of course, we can look at here, look for a target on previous price action, which this low falls well within that target because of the time. All we are using is time-based liquidity. Time-based liquidity is what we are using to trade. So this low becomes our target. A 1 to 3 and you close that case. Next entry would be at and remember, this is a live market. We are trading on the live market. We're not back testing. We are forward testing. So we go to 335 at sorry 935, 1035, right there. There we go. So right now, price is showing us some bullish tendencies. Now we are bearish, as I said, of course. But if you see price giving you signs of being bullish, you can also enter trade. Remember, we are scalping. So we look at this. This is an order block. Why do I consider this an order block? Actually, not just an order block, time-based order block. It's formed at the perfect time for the algorithm to respect it. So we have an order block here, and price hasn't offered into it yet, which leaves us with a positive, which makes it very positive because price rallied away, breakaway gap, did not offer into any inefficiency near it, neither is there a candle wicking after a closure above that high. There's no candle that wicked into this area before price rallied to the downside. So it's still a valid order block. Of course, it can be disrespected, but at the moment, we validate it because liquidity is resting right above it. The algorithm might decide to go for the liquidity above, and that's where most stops could we would put our stops most times. That is our buy side liquidity. So what we do, we just wait. As you see, price rallied, creating liquidity voids. So for liquidity voids 1, 2, 3, price normally runs for the liquidity void that is most discounted. What do I mean by discounted? If there is a range like this, from this high to this low, and there's a liquidity void, price will not come for the first one, not come for the second one, because this is not the best possible price to sell. But price will come for either this, this, or this. Now, reasons as to why it stopped here, because liquidity was resting just below, so it stopped liquidity and went higher. It could the algorithm might also reprice lower, but of course we're expecting lower prices, so we wouldn't want to buy just yet. Let's be patient and wait for the next window. So our next window will be at exactly 10:55 to 11:05. This particular fair value gap or balance price range or inversion balance price range, however you may see it, may look like the best opportunity to sell, but we still don't have enough confirmation to make our entry. Of course, you may say we have a dealing range right here, and we have a dealing range right here, and we would want to draw our feed from the high to the low, or in my case, the gun tool, and we look at the premium and discount. Now we are in the premium where we would want to sell from. We have just tapped into that order block right there, which could also look like a sell. But I need some sort of structural shift and confirmation that we are going to go lower for me to make an entry. So patience pays. So as I said before, this order book hadn't been offered into. It looked, it was the most discounted PDRA in order of PDRAs, and price repriced, and the smart money repriced from there, leaving the week of this candle, and then started trading lower. Now, I could have entered from here, but since I'm a very conservative trader, I did not want to take that risk. So what I'm doing is I'm waiting for this particular window to close, and then I make my entry. I see what I can do in this liquidity void that is being created here, and we look for an entry from there for sell. So what I consider a liquidity void is where there are more than two fair value gaps within a kill zone. So at the moment we have one, two. This is not counted because this could have been an implied inefficiency, but it's not. We have three. This is not. We have four, and most likely the fifth. So our main target would be for price to come all the way to the most discounted, which is this one, for efficient price delivery to occur. So this is our target for entry. Of course, we are now selling aggressively for now with our scalping strategy. So orders that were taken from this order block right here have been off are now going to be offered within this fair value gap or at the low right here, because this is liquidity. Liquidity is resting below this time based swing low right here. So the way this candle, last bearish candle closes within this inefficiency shows that there is uh, price is most likely to go lower. Why? Because the candle body has closed below 50%, the consequent encroachment of this fair value gap. So we are confident at this point that we are going to proceed going lower after the short-term retracement we are going to encounter. So let's look at our next window since this window has already been created, and we know that price should most likely return to that fair value gap right there. We have not had price return all the way into our fair value gap that we were expectant of. So we'll move forward. That doesn't mean it's not going to reach here, but it's just not a time for the price to do that. So we're most likely going to first run liquidity at this low, and then maybe retrace back to that inefficiency. Otherwise, it becomes a missed entry. And a missed entry is part of the game. Not every entry will make sense. And I had told you previously, the closure of these candles below 50% of this um, fair value gap is some sort of inducement to induce traders to think that price is going to continue going higher. So unaware traders would make buys, would take buy entries from this point, assuming they'll be coming back to, assuming this is a sell side imbalance targeting a buy side inefficiency, which is not the case because of the bodies of the candles. As ICT says, the wicks do the damage, the bodies tell the story. So we are sweeping this liquidity at this swing low. This low also came to deactivate this order block right here. There is this order block resting right here, which was meant to hold stop price from continuing higher. So when it was deactivated, liquidity was dropped on this week into that order block, which meant that the next time the algorithm comes back here, it's just going to run it. When price doesn't move the way we expect, we don't just let things be. We look back to previous price action and ask ourselves, why was this high created? And why did price reach here and retrace? Well, the answer is very simple. There's an inversion order block resting right here at 10:34. There's an inversion order block that was formed. This is an inversion order block. So the science behind an inversion order block is where is that? Is that price forms this order block. That's generally to stop um, the algorithm from going higher. Now, in this case, it was disrespected because it was in discount and we are going to a premium. Sorry, it was in this discount and we are going to premium. If we draw our trading range from this high to this low, a dealing range, sorry, a premium and discount dealing range, we realized that it was just short of being above. So price rallied below, did not even offer with this week, failed to offer, rallied below again, passed through it, came back, passed through it the third time, went up above it again, wicked above, wicked below, and then continued higher. Then, as smart money was coming back lower, did not even offer. After trying to offer here, just ran through, came lower to this fair value gap. So we were trying to rebalance this price action that was created at that point there. That is what algorithm was looking for to imbalance, to balance. Sorry. So if I demarcate this like that, you see the way bodies and no wicks. The wicks were either almost equal highs or just below, just like that. And then finally, when the time was right, price offered into that inversion order block, which is also time based, and then rallied lower aggressively to sweep liquidity of the daily objective. So the two candles that were meant to form these two candles from around New York session, New York PM session yesterday to the Asian session today, the liquidity that was resting below and above that time was just run through, and that was it. Otherwise, we should be happy with the bias we had, which was bearish. The entry did not come to pass because, of course, there was an inversion order block that stopped price from going higher. So price ripped into that and continued lower. These are simple things that we miss, and we have to journal them nonetheless. We journal missed entries, we journal losses, we journal wins, and we don't forget that this is the way things are. That's the game.